Knowing which stocks to buy is really only half the battle as an investor. A huge part of successful investing is knowing how to manage your positions, knowing when to cut your losses, and knowing when to take profits. Cutting losses is pretty straightforward. Worst case, you'll want to cut your losses at between 7% and 8%, or sometimes sooner depending on your time frame and other elements of the trade. Knowing when to take profits, however, can be a little more nuanced. The best rule of thumb that you should always go back to is this. Take at least some profit when a stock gains 20% to 25% from the buy point. IBD founder William O'Neill created this rule in 1961 when he noticed that after stocks break out from well-formed bases, they tend to run up 20% to 25% before correcting again. So it's smart to lock in at least some of your gains, as you never know how big that next correction could end up being. Sometimes a stock simply pulls back to a moving average, then continues higher again. Often, that pullback to a 50-day or 10-week line is a great place to add shares. Other times, a stock may pull back to the proper buy point, in which case it may be time to cut that position entirely, especially if it undercuts key moving averages along the way. The reason the 20 to 25% profit taking rule is so important is that when combined with the 7% stop loss rule, you could be wrong in 3 out of every 4 trades and still come out ahead so long as you're following these rules. However, as with all rules, there are exceptions. Here is where the holding for a bigger gain part comes in. So how do you know when a stock is going to keep running higher? When your stock hits the 20 to 25% profit zone in 1, 2, or 3 weeks after a breakout, it should be held for at least 8 weeks. This is known as the 8-week hold rule, and it's best applied only when the market is in a strong uptrend. When a stock triggers this rule, it's an indicator that you may have a true winner on your hands, and this stock may be worth holding for a much longer period of time. IBD research shows that in many cases, stocks that make this quick and powerful move are capable of doubling or tripling in price. Unless your stock shows a clear sell signal, you should sit on your hands for the first 8 weeks of such a move. IBD founder William O'Neill conceived this rule in the early 1960s after being shaken out of Certainteed, a winning stock. In a moment of market weakness, William O'Neill sold his position for only a 2 or 3 point gain. Then Certainteed went on to triple in price without him. Doing nothing can be a challenge for investors, but your 20% profit cushion should help ease that fear. Unless you're in danger of a complete round trip of your gains, you ideally want to hold your stock for those 8 weeks. It may appear to wane on occasion as it pulls back to or just below the 10-week moving average, but this action is normal. Then, once the 8 weeks are up, it's time to reassess the stock. Most likely, your stock will have returned to or surpassed the area of initial strength. From here, you can then decide whether to take profits or continue holding. Now, as market conditions change, it may be smart to also adjust your buy and sell rules slightly. In a choppier market, for example, you may find that most stocks are not making 20 to 25% gains. They may rise 10% to 15% before pulling back completely. If the market is reducing potential gains, you can change your profit-taking rule as well. But in this case, you must also reduce potential losses to maintain that balance. Here, you could adjust your stop loss to 3% to 5% to compensate. The goal is to stay within that golden 3-to-1 ratio. The bottom line is, it's always best to follow your rules, but stay flexible. Let the market tell you what to do while you honor those sell rules and your lines in the sand.